Stephen, thanks for joining us.
Sure.
Last week, oil fell 15%, biggest drop in 2 years. Do you feel vindicated because you told us this would happen about a month ago?
Yes, I do, actually. And more importantly, I feel financially vindicated. So it was a good week and it was a nice weekend. But be that as it may, that was history now. And where do we go forward from here? Now, a lot of what the forecasting we did at the Schork Group was based on where we were and the belief that we were in a mini bubble of sorts. Now, with all bubbles, it was based on the fundamentals, but we had a couple of big catalysts over the past 2 months. First and foremost was the geopolitical situation in Egypt and then Libya, which raised concerns with regard to future supply. That attracted a lot of investors into the long side of the market. And we also saw a recoupling with the dollar and with the nonchalance of the monetary policy with regard to the debasement of the dollar. You had more investors move into this market by selling dollars and buying commodities. Now, if we looked into the CFTC report, there was clear that there was a lot of speculative money coming into this market. And given that this bubble started right around $85, $90, we were fairly confident the market would get back to that level. My only concern up until last Thursday was that, yes, but just like in 2008, this market might get back down to $90. My only question was, would we get to $190 before we got to $90?
And what do you think now, Stephen?
Well, at this point, $100 a barrel, keep in mind, demand elasticity is still in question. Now, there are some key fundamentals in play here. There is a shortage in the Midwest of feedstock to manufacture summer-grade gasoline. That's causing some concern and some rise in price relative to the products. And as you just reported on the situation in Louisiana, the shutdown or the potential disruption to flows of refinery, you would certainly expect, just like we saw in 2005 Katrina, a widening of the spread between product prices and oil prices. And in fact, then you saw that was a catalyst to drive oil prices lower. You shut down a refinery, you don't have any demand for crude oil.
14% of the refining capacity actually may be taken offline from those floods. So at what point do we know if we're going to see such support that we do get to this $190 per barrel limit, as you talked about? Will we know in the next few days as the river crests?
Let me be clear. I'm not calling for $190. Just with the run-up in price, it got to such a silly level at $114. As Kane said, the market could remain illogical longer than that, it could remain solvent. So the point was that the speculators were coming in. There was no telling how high because it was already decoupled from reality at that point. Yes.
I don't mean to cut you off, but we know Qatar's oil minister said yesterday a stable oil price is OPEC's goal. Oil's still up 9% this year. Next OPEC meeting, June 8th. And cartel members are saying it's too early to say whether or not it will pump more crude. What do you expect, and will it matter?
I mean, it will certainly matter to the point, but we have to keep in mind this run-up since February had nothing to do with OPEC. OPEC wasn't pouring speculative money into the oil markets. It was investors. And a lot of those investors gave that money back this week. So it's going to be more important with the value of the dollar when OPEC meets again, because if the dollar is stronger, I am confident we will be low. I'm confident if we have a significant rally in the dollar, that oil will be closer to $80 than it will be to $100. And certainly that will not concern OPEC. And we'll have a stable meeting, likely. However, if the dollar resumes its downward trajectory, oil is headed well back above $100, and that might put pressure on the group to raise production.
Stephen, you've put into really clear terms the relationship between the dollar and oil. The euro, though, I'm watching too. I mean, recuperating after last week's drop. Can we use the euro's strength as a proxy for oil, for direction?
Absolutely. There was a breakdown in the relationship between the currencies in the fourth and first quarters, but what we saw at the start of the second quarter was a recoupling. So there's a very strong correlation between the euro-dollar cross. So as the euro rises, or if the euro continues to rise now, you will see oil rise along with it. Very high coefficient of determination, so there is that strong link. It's very important, and that's a big question now because we are coming to the end of QE2. What does that mean for the dollar? If that is bullish for the dollar, great news for the oil bears. I do believe we follow lower. But if that's been priced in already and the dollar fails to rally at this point, it's going to be difficult for consumers this summer because we are likely looking at higher prices.
Higher prices and fewer road trips. Stephen, thanks very much. Stephen Schork from the Schork Group.